Hi, this is Jamie from Wize Mentoring. Welcome back to the next exercise of the discovery stage of this course. What we're going to be looking at this video is the Wize EBITDA Value Calculator. We're going to explore the concept of a personal exertion income firm versus a passive income firm. We're really going to have a look at the difference between both. And before we start delving into that, I just want to say that the Wize mentors believe that the definition of a business is a commercial, profitable enterprise that runs without you. And I'll say that again. The definition of a business is a commercial, profitable enterprise that runs without you. That's really what we're focusing on over the next couple of exercises. So let's start. So over this side here on the left, which is where most of us are at, and where I was at a few years ago, I had a personal exertion income firm, and I was always thinking short term. If we have a quick look at that, the revenue is generated by the owner or yourself of generally of a firm, say with 800,000 in fees. Approximately 250,000 in fees are generated by the owner. Around 550 are generated by the team. On the other side, where you've got a passive income firm and someone who really thinks long term, all of the fees, 800,000, are generated by the team. So you can see the difference straight away in terms of the owner's or the partner's time. Moving down a little bit further, we look at the cost of goods sold. With a personal exertion firm, often we have the owner or the finder, if I can call that person, they're on a market salary, roughly 150 for example, and the rest of the cost of goods sold is the grinders or the people doing the work. And generally the cost of goods sold is around 40%, which is 320,000. On the other side of a passive income firm, we just have a manager, if you like, a client manager or a minder. Their salary could be anywhere from 100 to 150. The rest of the team is there, and again we've got 320. So in this case you can see here that we don't have the owner or the finder involved in the firm. Over the course of the next 18 modules, we'll talk a lot about finders, minders and grinders, and we'll go into depth around what their role is and what they should be doing. So if you move down here a little bit, we'll get down to the gross profit, which is around 60% or 480,000. And then on the side of where we have a firm, a personal exertion firm, there's no salary for a practice manager because the owner, he's working full-time in the practice, in the business. He's managing all the staff and managing the day-to-day operations, and therefore that's just made up of the rest of the overheads. On the alternative side, where we have a passive income firm, this firm has hired a practice manager of around 50,000 to help with the operations of the business and process all the administration, all the admin, and so the overheads in this case comes to 280 with the practice manager. The final result is, on both sides of the slide here, we've got an EBITDA, which is earnings before interest, taxation, depreciation, amortization, or just purely cash flow of 25% of the 800,000. So that leaves us with 200,000, and we've got the same case over here. So over the course of the Sky Mentoring stages, we're really looking at the difference between these two types of firm. One firm is where the owner is working in the business. The other side is where the owner is working on the business. And in this case here, for example, this chap here, he's a slave to his business. And what sort of outcomes do we have? You know, this person is the business, doesn't really have that much freedom, no choice, works in the business, doesn't have much time, doesn't have any time for traveling, lifestyle, and doesn't even have time to expand the business further. Over this side we have this chap who's very happy, this owner, and he's full of joy, and he really comes to work and he says, what do I want to do today? He's got freedom of choice. He can work on the business, he can start other businesses, he can have lifestyle choices, including traveling, and he can decide to expand the business as well. In order to get from this side to this chap over here, it's really about time management quadrants. 7 Habits of Highly Successful People. Dr. Stephen Covey mentions this, and it's all about the distinction between what we call Quad 1 time management versus Quad 2. Quad 1 type activities are urgent and important. Quad 2 activities, they're not urgent but they're important. And what we find is people who are slaves to their business, perhaps like this chap over here, they solely work in Quad 1 and they're just working in the business. The key that we'll talk about in detail throughout the course is where we get a business owner or the partner to work in Quad 2, which is working on things that are not urgent, but they certainly are important. So we'll touch on that a lot more detail as we go through the course. So really a couple of questions here around a personal exertion firm versus a passive income firm that runs without the owner. So the question is, if we removed you, the owner, from your business, would it continue? As an owner, are you working in the business? Are you working on the business? The answer to that really directly affects the value of your firm or practice, whether it's a bookkeeping business or an accounting business. And if we just have a look at this slide for a few moments, we can see this side, we've got the income type. It's passive income on this side versus personal exertion income on this side. When we have passive income, generally the owner's role, he works on the business. On this side, they work in the business. If you have a look at the business risk, where the owner doesn't work in the business, is not involved in the day-to-day operations, the risk is often lower to medium. Whereas if we have someone who, an owner who works in the business, then the business is really affected by the situation and the circumstances of the owner, so the risk is often higher. Now all this is associated with what they call return on investment, what they call the multiple, and I've just included in there too for accounting practices and bookkeeping practices what is widely known in the industry as a fee multiple. For example, in this business, if we've got say $800,000 worth of fees, a lot of the time the valuation can be $1 for $1 per fees. So you can see here in this example, that's a return on investment of 25%, a multiple of 4, and $1 for $1. If we were to pay slightly higher than that, and because this business was less risky, less subject to the owners of the business, then for example we might pay say $1.25 per dollar of fees, which would value the practice at about $1 million with $800,000 worth of fees. So the point here is the more that you can work on your business as the owner and remove yourself from it, the more likely that your business will be valued a great deal more versus where you're solely working in the business and the business is reliant on you. So the question begs, how do we move from a personal exertion business where you as the owner are working in the business, and how do we move over to a business that can give us a passive income and the lifestyle that we deserve? What Ed taught me on this journey is what we've coined the Wize Journey. And what it really starts with the owner withdrawing themselves from the business as the business grows. So very quickly, we start with removing ourselves from the administration tasks. We remove ourselves from the production of tax returns and bookkeeping and financial statements. We're left with managing our staff and our clients. Eventually, as we get big enough, we can put client managers and a team in place, and as the owner or the partner of the business, we can remove ourselves from the managing. That leaves us then with the responsibility of marketing and sales and being the CEO and really working on the business, and that's a great threshold to get to. Finally, the last three stages of being the executive chairman of your business, as Ed Chan is the non-executive chairman, and then finally later on we can decide to retire and we can decide to be a shareholder in our own business. The next exercise slides, we will talk a bit more in depth about should we sell our business versus keeping it as an investment. The question begs now is, how is this achieved? How do we move from a personal exertion business to one that's going to give us a passive income and a lifestyle that we require? The Wize Guys mentoring team, we've coined this KSE, and it's all about the knowledge and the strategy, and that's what we're going to supply to you. 95% of the work will be required by yourself as the owner of your business. If you follow the slides and the detailed content, you will journey down this path as I just explained here. But it's with the KSE, the knowledge, the strategy, and the execution that you'll get the results. So yeah, hopefully you're really at this stage. If that really makes it crystal clear around where you're at now and the vision of the firm or practice that you'd like to develop so that it can run without you. You know, the question is, are you ready for that journey? So we here at Wize Guys certainly hope you are, and we'll support you along the way with all the questions that we can answer for you. Thanks for that. Bye for now.